Okay, with that, I want to move on. I want to move on to our first panelist, Jason Riveiro. Jason serves as the Executive Director and Chief Operating Officer at NAHREP, the National Association for Hispanic Real Estate Professionals. I'm getting a little tongue-tied today. Jason will share highlights from the 2023 State of Hispanic Homeownership Report and a bit of information from the State of Hispanic Wealth Report that was just released about 6 days ago. Jason has a wealth of experience serving Hispanic consumers and understands the importance of housing counseling. Following him will be Jaya Day, who is the Quantitative Analytics Director at Freddie Mac. Her role there involves research on housing policy issues with a focus on affordability, access to credit, understanding barriers to minority homeownership, and housing supply. She'll be talking about data related to housing affordability, consumer readiness to purchase, and will offer some specific data related to Hispanic consumers. We are so excited to have these two panelists with us here today. And with that, I'll hand it over to Jason.
Hello, thank you, everybody. Thank you, Ellie, for this opportunity to connect with your network, and thanks for hosting us. During Hispanic Heritage Month, and it's a great reminder of all the different folks within your network. I'm sure from all parts of Latin America and around the world. So for me, it is my pleasure to kind of talk to you today about our State of Hispanic Homeownership Report. This is actually our 14th year of publication. So this report brings together a broad cross-section of research and data from within and outside the industry. So our research team really coalesces a lot of publicly available data from the U.S. Census, the Bureau of Labor Statistics, the HMDA data, and Federal Reserve in order to put this report together. One part of this, in addition to what we've done, is we've also surveyed from more of a qualitative data standpoint. Many of our members working with Hispanic home buyers, mainly on the buyer side, agents, many of the individuals that you work with as a whole. Now, this report was released obviously earlier in the year, and a lot has changed. The market has certainly taken a change, and I think we foresaw a lot of these things happening in terms of knowing that we have some strong momentum, but the headwinds are certainly much stronger when it comes to the affordability and especially the supply side of things. I'm sure you're experiencing every day as you're working to get people not just qualified, but just find a home in the marketplace. So I'd love to hear from you if you're in the chat, or love to know some of the areas that you're faced with and impacted with. So we go into the first slide. It's important to look at. Actually, we'll keep going. Next one, there. Next slide. There we go. So as we look at 2023, we're much more conservative on analysis. Some had shown that the homeownership rate hit 50% mark. We felt that it was good to stay within the 49.5 based off of what we're seeing in the marketplace. So interesting enough, though, I think that it has been the largest. So we've seen now, I think, the largest increase in homeownership rate across any racial or ethnic demographic compared to the year prior. So last year was a tremendous year. And the last time that the homeownership rate neared 50% was in the 3 years leading up to the 2008 housing crisis. So in a positive note, we've made up for a lot of those losses after the housing crisis to get us to this point to where we are now. Where we're seeing a lot of this, and of course, this is no surprise, and this continues even as we look into Q1 of this year, which is the outstanding rate of household formations. So last year, I think we had about 450,000 households you know, we're seeing that surge continue to happen even into this year, even despite a slowing down in the home ownership rate, which I'm sure our friends at Fannie can allude to in their presentation. We can go to the next slide. Not only if you break it down, it's a little hard to see, but we have a copy of this we can share with everyone here. It's also available for download, but we saw that the household rate is a big part of that and kind of impacting those record-breaking numbers year after year. So that momentum will continue, in my opinion, to occur. And so, you know, this is not something that's going away, right? We like to talk about the stat that the Urban Institute put out a couple of years ago, which basically saying that between now and 2040, 70% of new home buyers or net new home buyers will come from the Latino market. So this is a surge. This is continuing to move forward. And despite everything, I mean, I was very surprised. I'm sure many of you were, that even despite the high interest rate environments, many of you know, within our community, we're still moving forward with home ownership and the importance of it. So the Latino market certainly is at the forefront of this. We go to next slide. And why is this the case? Not just from a household formation standpoint, but as you know, most Latinos are young, right? A larger share of Hispanic home buyers are under the age of 25 compared to non-Hispanics. So if you look at just the median age, they're just stepping into those prime home buying years as compared to the broader population. So this is a big reason for that. So Latinos tend to buy homes younger. Using HMDA data, we can see that the larger share of Hispanic home buyers are under the age of 25 compared to non-Hispanics. And so this report also notes that in 2022, which was the most recent HMDA data available at the time of the publication, 7.1% of Hispanic home buyers were under the age of 25, compared to 5.7% of non-Hispanics. So even in terms of when you look at demographics, Latinos are looking to purchase home at a much younger age compared to the broader population. In line with this trend, you know, agents within our practitioner survey said that the majority of their buyers last year tended to be between the age of 25 to 35. I'd love to hear from those in attendance here what you felt the average was for you. We go to the next slide, please. In this slide, we look through what is it, the age breakdown of Hispanic and non-Hispanic populations by generation. So Latinos make up disproportionately larger segments of the country's youth population, and that's why we can account for those trends kind of continuing. So today, 26% of children under the age of 18 are Hispanic. That's 1 in 4. And 2/3 of the Latinos are millennial or younger. If we go to the next slide. The report, of course, look into it, which would be very, you know, obvious to many of you here, which is one of the things looking at this report was the largest barrier to achieve home ownership was certainly interest rates. And in October of 2023, the average 30-year fixed rate reached that high of 7.79, which was the highest since 2000. And so, you know, an interest rate rising faster than since the 1980s. So certainly that's something that we're seeing something cool down in the marketplace, and potentially hope maybe you're seeing a little bit more demand. But as we know from appreciation and everything, as we go into the next slide, that home prices appreciation are slowing down in some markets, and maybe hopefully it's enough to help your customers as they're moving forward. So year-over-year home appreciation in April of last year was 2.3%, as a far cry from the record high of 19.5, which we saw in April of 2022. So that rate of appreciation for what we're seeing is slowing down. I know that the GSEs are looking at that as well. So it's certainly appreciating, but it is declining proportionately. If we go to the next slide, we look also examine within the share of home prices for sale. So over the last several years, particularly during the pandemic, home prices have gotten out of reach. We know that. And the slide here was created in partnership with Realtor.com to show the share of homes for sale at different price points. So in 2016, the majority of homes for sale in the market were in the most affordable price ranges. In 2016, 39% of homes for sale nationwide were priced under 200,000. Now look at 2023, it completely reversed, right? The smallest share of homes were listed that were listed under 200,000 only accounted for 13.8% of overall. So in contrast, the homes in 2023 were priced much higher in those ranges. More than 40% were 500,000 or more. So it's no surprise that we see that being an issue. As we go to the next slide, though, we know that Latinos, despite all of this, continue to be very resilient. And we've seen that the record-breaking growth among Latino home buyers. We saw that, especially in the survey, that 3 strategies that are very important, I think, as you're looking at is one, within many of the buyers is relocation, right? Latinos tend to be more mobile. And so we're seeing that going to places where affordability is available, where work is available. Secondly, I think taking advantage of co-borrowing, right? Some different strategies here as people that work with folks, as you know, this is a multi-generational. Many are multi-generational or multi-borrow co-signers, co-borrowers that are part of this this loan package that is being put together. And of course, the local programs and financing incentives that all of you work very hard to put together are really some of the same factors that a lot of our practitioners are accounting for the ability to get people into homes. When you look at slide 11, we focus on that mobility factor, right? Which is that net migration by state. So first, relocation, Hispanics are willing to relocate from higher to lower cost markets, both long distance move across state lines and find more affordable neighborhoods. Between 2022 and 2023, Texas, Pennsylvania, Georgia saw the highest net migration, or Latinos moving to their state, while Oklahoma, Florida, and California saw the largest out migration, right? Leaving those areas there. Agents in our study noted that many of their clients were willing to look outside their desired location to find affordability. Do you find the same thing with your clients? It'd be interesting to hear. In the next slide, we actually look at it again, going to those opportunity markets. We do more of a deep dive, and it's always not just, it's the non-traditional markets that are on there. For example, within my state of Ohio, there's several there as well. And this is where you're starting to see where this is what we worked with Freddie Mac to put on, and maybe this is something that Jaya might be able to do a little deeper dive on. But we looked at the markets that hold the most opportunity for home ownership growth. We partnered with Freddie Mac to identify the places where large Latino populations and where those households could afford a moderately priced income home. And Freddie Mac defined moderately prices as 80% of median home value for this report here. So the top markets last year were St. Louis, Missouri. Texas had many on the list as well, and we're seeing opportunities in the Midwest and the mountain region, like Michigan, Nevada, Oklahoma, and Ohio. Next slide. When we look at the co-borrower situation, so this multi-generational factor that we see, we know that our practitioners know that oftentimes, folks are coming to the table with their grandparents, their parents, their children, or in extended families, right, to purchase a home, and the importance of that nucleus. So that's certainly a big part of that. In some cases, I think co-borrowers choose to buy or live together, while other support it's intended to come off the loan at some point in the future. But I think for the agents that we surveyed, agents in the Northeast said it was common for extended families to buy multi-unit properties together, and some, be interesting to see what you're seeing in your marketplace. If we go to the next slide, we go, a little deeper into that multi-generational side of things. And this we know that in this breakdown, you see how Latinos and non-Latinos compare regarding household composition. So in 2022, there were about 5.9 million multi-generational Hispanic households. That's nearly nearly one third at 31.9%. Comparatively, that's 18% of non-Hispanic households are multi-generational. So the significant difference between Latinos and non-Latinos in terms of multi-generational households. So when working with agents, and I'm sure all of you are working very hard on this as well, is another strategy we've seen our agents helping them to identify local financing incentives and programs for first-time home buyers. During our interviews, top buyers agencies, we've heard that top buyer agents, we heard that many home builders, state and local governments, and financial institutions are often offering programs to lessen the financial burden, particularly for first-time home buyers. So rate buy down and local down payment assistance programs were particularly impactful last year. And I think even more so, I've heard even to this day, I-10 products have certainly increased significantly in terms of the conversation that I'm having with different lenders. The interest to be able to maybe securitize and find these programs has become much more prevalent than I've ever seen, I think, over the past 10 years. Next slide here. As part of our report, we release our policy priorities, and this is something we can go a little bit more into in the report, but we have 4 key areas. So our housing affordability, access to credit, the industry best practices, and then the broader macroeconomic issues that we like to focus on. So with that, I'm going to close on another report, and I think we have the link we can share with everyone. Actually, last week we released another report that we put out every year. It's called the State of Hispanic Wealth. And in that report, we look at not just home ownership rates, but we also focus on other areas which we find are paramount to increasing wealth, which are access to credit, specifically for small business, and the diversification of wealth, which talks about encouraging the community to save and invest in other things outside of home ownership. This year, we looked at and added another factor, which I think is very important, and I think becomes an increasing important issue for all of you housing counselors as well, but it's protecting those assets. So making sure that individuals have wills and trusts to make sure that their assets are protected for any unforeseen situation. So that is something that we're looking at, and we put together some myths based off of this report to address head-on some myths that we felt needed to be covered. And I'll hit on those very quickly, but one of those is that the wealth gap between Hispanic households and non-Hispanic households is growing. And that's actually not true. Actually, there's been a significant change in terms of the gains that Latinos have made for growing their wealth. So while the growth in Hispanic household wealth for the last decade is significant, it doesn't fully account for many other factors, so age and such. But Latinos, in fact, have shrunk the wealth gap by almost half. The second myth is that Hispanics predominantly purchase real estate in low to moderate income neighborhoods. So actually, last year, we saw that about in 2023, 71% of real estate purchase financed by Hispanic borrowers were bought in middle and also upper income census tracts. So very interesting to see how a lot of those originations, are starting to happen in some of these middle income census tracts as well. We also look at Hispanic-owned firms and a higher percentage of Hispanics, and the percentage of Hispanics that use financial services or unbanked, and that's also an area that we studied in this report. And then finally, as I mentioned, in terms of the importance of estate planning and the work that we need to do, and that there's not enough wealth, and there's certainly wealth in the community to make sure that we protect it. So with that, I appreciate it. I look forward to answering any questions you might have during the course of this. But I'm going to pass it on now to Jaya with Freddie Mac.
Thank you very much, Jason, and thanks, Ellie, for inviting me to this exciting conversation. My name is Jaya Day, and I am a quantitative analytics director from Freddie Mac. My team does a lot of research in trying to understand the barriers to racial homeownership gap and sizing future opportunities around first-time home buyers. So today I'm going to share some new research that Freddie Mac has done to size future opportunities. And it's exciting. This is the Hispanic Heritage Month, so I have some insights for Hispanic opportunities as well after I overlay the or go over the methodology or approach that we have come up with sizing market opportunity. Let's go to the next slide, please. All right, so how do we holistically think about opportunity or think about who are the potential home buyer households? Go to the next slide, please. So this is basically showing the house prices and elevated mortgage rates. Ever since 2022, we have been seeing that house prices and interest rates have been rising. From January 2021 to I think end of 2021, interest rates were pretty low, and we had experienced refinance boom during that time, and overall originations actually boomed. But after that, the interest rates started rising because Fed had to control the inflation. Inflation was pretty much out of control. So to control the inflation, Fed started rising the interest rate. And the hope was that it would lower the inflation, including the house price inflation, but that didn't happen. And one of the reasons is because house price, the shelter component of inflation remained pretty static and it did not go down. So as you can see, the line in this chart here, we have the monthly average rate for 30-year fixed rate mortgage, which is the green line, and then the blue line gives the median house price. This is all national average. So the interest rates currently, we just had a rate cut yesterday, and it's around 6.09 for 30-year fixed mortgage. But then you see that the house prices have not been much impacted due to a rate cut, and it has been pretty static. So the shelter component of inflation has not been actually not been able to decrease as much, and the reason is because of the supply shortage. A lot of the 2/3 of the existing homeowners are currently locked into a rate which is 4% or lower, and hence they are very hesitant to put their houses in the market, which is leading to a supply shortage and as a result exacerbating the house prices. So given that house prices and rates are so dynamic, when we think about market opportunity or how to size market opportunity, we have to make sure that we are very current in incorporating these factors or players in in our calculations. So a lot of the things that Jason showed, Freddie Mac contributed to the report. So when we did that analysis, we were thinking about more static, right? So the publicly available data sets that were used to for the NAHREP report, they are either a little lagged or they don't really evolve as fast as the changing market. So in our new approach, what we did is two things. First, we wanted to size the opportunity such that it moves dynamically with the market. We are able to track these trends quickly as the rates are changing or the house prices are changing. So we wanted to make our opportunity calculation as comprehensive as possible so that we are incorporating rates, house prices, changing taxes, changing insurance into our calculation. And the second thing is we brought the credit bureau data. So we basically, one thing that was missing in the publicly available data sets is the credit side, the credit attribute of the potential home buyers, right? So that's another contribution we did when we were refining our methodology to think about opportunity, which consumers are potentially ready to become first-time home buyers. We wanted to also incorporate their credit side, the credit profile of these consumers. So our comprehensive methodology not just includes these macro factors, changing macro factors like house prices, interest rates, insurance, taxes, but also the credit side, their credit and debt attributes, the non-housing debt attributes, to basically give us a comprehensive look of the opportunity at a given time and how that evolves over time as these players are changing. All right, so let's go over some of the detail on on our new methodology to size the opportunity. We call it the building blocks methodology because it's really like a building block. So this is just a concise way of how we are bringing all these factors into our calculations. So we start with the credit visible population, the population who have their records in the credit bureau, and then we look at their consumers of certain home buying age between 25 to 55. So as Jason mentioned, a lot of the minorities, especially Hispanics, tend to be younger and they are getting into that prime home buying age. So we want to make sure that our opportunity is aligned with those who are going to be future first-time home buyers rather than those who could be like already in the market and repeat purchasers. So we want to basically be more surgical in sizing the opportunity. So we limit the consumers of certain home buying age between 25 to 55 in the credit data, which has the credit profiles. Then we go to the next step where we do credit profile screening on these consumers. So basically, we check, are these non-mortgage holders? Because again, we're trying to size the future first-time home buyers. So are these non-mortgage holders in past 3 years? Just to make sure that they're consistent with our GSC's definition of first-time home buyers. Are these non-property holders? So they could be non-mortgage holders, but they could have a property free and clear, given that there has been a rise in the cash buyers. So, and we don't want those, right? So we take out those who are non-mortgage, who are mortgage holders, or who have a property, who have their names in deeds. So they should be clearly non-mortgage holders in last 3 years and non-property owners. And then we do a simple credit profile screening, like their credit score should be above 661. They should have no foreclosures or bankruptcies in last 7 years, and they should have no severe delinquencies. So then once they pass the credit profile screening, then we go to the next building block, which is assessing their affordability. This is where a lot of these macro factors come into play. So basically we ask, have these consumers, do they have enough income to afford their current non-housing debt, student loan debt, credit card, auto, all of that, and monthly payment on a moderately priced home in the area that they are living in, under the assumption that their maximum allowable back-end DTI does not exceed 43. So why 43? Because that's the QM rule. So that's like, we put a threshold that is kind of a conventional wisdom. Obviously, there are exceptions, and minorities, many of them do tend to have a higher DTI. But for our calculations purpose, we just use the the QM rule, which is 43%. So here in step 3, we are assessing if they have enough income to afford their non-housing debt plus an estimated monthly payment on a house, on a moderately priced house in the area that they're living in. So that's the third building block. And then after that, we just convert these consumers into households, because not every consumer is going to be a single applicant. They usually form households and apply for a loan, right? So it's to think about the opportunity, we do need to think about in terms of households. So we apply discount factors to convert these consumers to households, and that's what we call the potential home buyer households or potential future first-time home buyers. All right, let's go to the next slide, please. All right, so applying this methodology, we want to see how how that market has evolved ever since the interest rates and house prices increased. So we have the numbers from 2021 January all the way to 2024 August. So in 2021 January, based on our approach, there were 9.3 million potential first-time homebuyer households who could afford in their area. And that number declined to 5.1 million, marking a 45% decline, primarily due to rise in interest rates and house prices. Let's go to the next slide, please. So then I hope I convinced you that this market opportunity evolves with the rates and the house prices. So it's very important that we don't really, I mean, we think about the opportunity it's a dynamic field, right? So we want to understand that how is that field sensitive to changes in these factors. So some of the sensitivity analysis we did, one key analysis that I want to share with you is basically the sensitivity of the potential to the changes in mortgage rates. So here what I'm showing you is on the y-axis, I have the potential homebuyer household counts in millions. And then on the x-axis, I have different rates. Because we don't know how the rates are going to be a year from now, right? I mean, until yesterday, we didn't know how much the rate cut is going to happen. So to kind of think about strategies or what strategies we should be using in what markets, it is important that we get the kind of a ballpark or a range of, okay, if the interest rates are changing in this direction, how do we think about the opportunity, like, you know, in terms of quantifying the opportunity. So that's the purpose of this slide here. So wherever that red is crossing the blue line is where is the 5.1 million potential homebuyer households as of 6.49%, which was last month. And now we see that if the interest rate actually declined by 100 basis point, 1% decline, the opportunity will go up by around 8.8 million. So there will be an increase in 792,000 potential homebuyer households if interest rates decline by 1%. And based on the latest decline in interest rates, the opportunity actually went up to like a little bit more than 5.4 million. All right, let's go to the next slide, please. So then if I think about like, okay, what matters more? Does the interest rate matter more? Is the opportunity more sensitive to changes in interest rate or changes in house prices? So to better understand that, what we did is we did some back of the envelope calculation. We say that, okay, to get to that same increment in opportunity, that's 0.8 million, like 792,000, how much should the house prices decline? So that's what you see here in this chart. So the first bar is basically the opportunity as of August 2024. And then the second chart is the opportunity, the enhancement in opportunity, or the increment in opportunity if the rates drop by 1%. And the little increment is like 0.8 million, close to 0.8 million. And then in the third one, our back of the envelope calculation shows that to get to that same outcome, the house prices need to drop by 8%, which is a huge decline. The 10-year average of house price changes or appreciation is around 5%. So to get to that same result or outcome, the house prices movement is huge, is humongous, which basically tells us that the sensitivity of the opportunity to the rates is much more compared to the changes in house prices. All right, next slide, please. Thank you. So regardless, we do want to be cognizant about house price forecasts, and Moody's publishes house price forecasts. And this is basically another calculation which shows that, okay, if we incorporate Moody's house price forecast as of December 2024, so according to Moody's, the house prices are going to be on average increasing by 0.7% by end of December. Now, this was before the rate cut. So now they will probably have a new updated forecast. So you can see that if we incorporate Moody's forecast, then the orange line is how the opportunities will decline. The average difference is around 44,000. So on average, the potential homebuyer households would decline by 44,000, keeping the interest rate constant. So if you want to understand, okay, how does that, like, you know, the combination of interest rates and house price changes, how will that impact the opportunity? So then you can like basically see that on x-axis, I have interest rates changes. So taking the interest rate change, for example, if it declined by 50 basis points, so at 6%, we can see that the opportunity would be around 5.4 million at the end of the year. All right, go to the next slide, please. So then how has the, so given that I showed you how our new approach works in sizing the market, we also have the ability to slice and dice this overall number into different segments. And one of the segments that we have looked into is the income segment. So if you go to the next slide, please. So we try to better understand the opportunity by various income bucket. And this is important because, as Jason mentioned, a lot of the minorities are not just LMI, they are also middle income. So we want to better understand how different opportunity are trending by different income buckets. So here I have different snapshots. So February 2021, February 2022, 2023, 2024, and then August 2024 is the latest that we have. And you can see that overall, it declined from 9.3 million to 5.1 million, something that I already showed you a couple of slides ago. Now I'm just taking that pot and then kind of dividing them, distributing them into various income buckets. So I have the very low income bucket, which is the first row, the second row, which is 50% AMI or below. The second one is the low income bucket, which is 80% AMI or below. The third one is the middle income bucket. We define it as between 80 to 140% AMI. And the fourth one is the high income bucket, which is above 140% AMI. So you can see that the biggest decline in opportunity is the LMI and the very low LMI. So for LMI, if you look at the opportunity, it went down from 3.8 million to 1.6 million. So almost halved. In terms of middle income, that also declined from 4.3 million to 2.3 million. High income didn't change much. The sensitivity of the high income opportunity for interest rates and house prices, we don't see that as much. All right, now what I'm going to do is basically, just as an example, I'm going to take the LMI bucket and then do a little bit more analysis on that to show that how our approach is working. And then we will go into Hispanic opportunity. All right, so let's go to the next slide, please. All right, so let's take this 1.6 million LMI potential homebuyer households and try to see where they are located. So this map here basically plots them based on their location, where they are living. And this is a CBSA level map, so the metro level map, basically. So they are like 4 or 5. So you can see the bins are given below, which is giving you the legend. So a lot of the opportunity is in the Midwest and the South, especially for the potential LMI households. So the big markets that kind of pop out are Chicago, Minneapolis, Dallas, Detroit. So these are Philadelphia. So these kind of pop out when these markets still have opportunity for the LMI potential homebuyer households, regardless of the challenging affordability that we are facing. If you go to the next slide, please. All right. So now we want to also better understand how about the supply side. Even if I have opportunity, I kind of highlighted or identified the markets that has opportunity. If I don't have enough housing units, I can't be successful in putting these people in the houses, and they cannot successfully transition into homeownership, right? So we do need to better understand the opportunity, also bringing the supply side of the story. So that's what we do here. What I'm trying to show you is what percentage of the inventories that are listed for sale are affordable to the LMI living in that area. So we have access to non-public listing data from various vendors, and we are able to see how many houses are listed, housing units are listed. This is basically single family houses, but we also have access to condo data. So basically how many single family housing are listed in these markets. And then we are able to do a back of the envelope calculation to see what percentage of these listings are affordable to the low to moderate income families living in these areas. We could do the same for middle income as well. So what you're seeing here is the shares. So basically, if the lesser is the share, that means more unaffordable the market is to the LMI, the higher is the share, the more affordable the market is to its LMI. So a lot of the opportunities, again, are in the Rust Belt, as well as at the South. So the market that I showed you before, Chicago, Detroit actually has much higher share of the affordable listings for its LMI households, as well as Philadelphia. All right, let's go to the next slide, please. So another thing we want to understand to make all this actionable, right? So I showed you a lot of data. Okay, let's look at the demand side, size the demand. Let's look at the supply side, size the supply. So we can pick the markets which has favorable for both, like which looks favorable from the demand perspective, from the supply perspective. But now what? How do we help? How do we make this data actionable? So one of the things that we can help with is down payment programs, right? We can find out how much do they need to put towards cash to close, and where some of these products and programs can be successful, right? So this is basically this, so we try to estimate the cash needed by the potential homebuyer households based on certain assumptions to kind of, excuse me, assess where some of these, excuse me, I'm going back hole, where some of these programs could be successful. Now, in the data that we have, or in fact, in majority of the data sets out there, there is very little information on wealth, savings, or reserves. So it's very hard to tell for indefinite, like, come up with a definitive way to find out how much budget or how much reserves do they have that they can put towards closing cost, right? So we have to come up with some scenario analysis. So what we did is, here we looked at 3 different scenarios. So let's say if the potential homebuyer households, this potential first-time homebuyer households, came with 0 savings, they didn't have anything, but they still can qualify based on their income, they can still qualify. So they are, they have the potential to become first-time home buyers, but they have 0 savings, which means that the cash to close short. So then what is their cash to close shortfall under that scenario? So that 13,000 is what you see is on average the cash to close shortfall nationally. And this is basically calculated under the assumption that they have to make 3% down payment and 2.2% closing cost on that median priced home in their area. So so that's 13,000, that's no reserves. The next one is if they come up with 6 months saving, right? If they're coming up with 6 months savings, that means they have some skin in the game, then what is the average cash to close shortfall? So in this scenario, we just subtracted the 6 month savings from their cash to close requirement, that 3% down payment plus 2.2% closing cost minus 6 month savings, to see how much is the gap, the cash to close shortfall. So on average, that's around 11,000. And then the last scenario is under 12 month savings. If these households are coming with a 1 year saving, then what's the cash to close shortfall? So that's around 10,000. So if you go to the next slide, so in this slide here, I'm just going to look at the cash to close shortfall under 6 month savings, that second scenario, for the LMI potential homebuyer households, to see how does that vary by geography. And it varies extensively by geography because it's all tied to the house prices. The 3% down payment plus 2.2% closing cost is all tied to the house prices. So the more expensive the area is, the higher is the cash to close requirement. And since LMI doesn't, their income is also pretty restricted, with 6 months savings, it doesn't cut it. So a lot of the high cost areas, you can see that the cash to close shortfall is much higher. In places in California, it could even exceed 40,000. But in the low cost areas like Midwest and South, the cash to close shortfall is much less. It could go as less as 7,000 in places in West Virginia. And you can see that there was a teeny place in Alabama where it's less than 5,000, probably the only one. Or sorry, it's Arkansas. All right, let's go to the next slide. So with all this, What does it mean for potential home buying opportunity for in Latino markets? So now we are going to just basically identify some of the markets where Latino population is concentrated, and then kind of blow it up and see all these opportunity, like in terms of how many potential home buyers households are there, what is the supply side look like, what does the cash to close shortfall look like in these markets. So let's go to the next slide, please, to basically look at some of the Latino markets or some of the areas where Latino Americans are highly concentrated. So this is basically from the census data. Unfortunately, in our credit data, we are not able to identify race ethnicity. So we have to overlay the census information to kind of figure out what are the big Latino markets. So here we have some of the big Latino markets. California has always traditionally been a Latino, very highly concentrated Latino market. We have Texas, Florida, some non-traditional markets as well, such as Chicago, Illinois, and then we have East Coast. So given that, let's look at some examples of how these Latino markets look like in terms of potential home buying opportunity. If you go to the next slide, please. So I took three examples. One is, California market, San Jose, the greater San Jose area. And then I have two markets from Texas, Houston and Dallas. So what I have it in the heat map is the count of the potential home buyer households in these markets, right? So when I compare across the three markets, since Houston has much bigger opportunity, and then on the right-hand side, what I have is basically overlaying the supply side as well as the, the cash to close shortfall. So overall, in the United States, the median cash to close shortfall with 6 month savings is around 12,000, as I showed you a couple of slides ago. And then affordable active listings, if we are thinking about targeting LMI, it's around 24%. Like that's a national average. 24% of the current active listings are affordable by the LMI living in their area, right? And then we have the same metrics for these three markets. So looking at the comparing across the markets, seems like San Jose definitely has its highest affordability constraint. It has more like close to 50,000 median cash to close shortfall, even with 6 month savings, even if the people are bringing 6 month savings to the table. And then affordable active listings in San Jose is only 12%. Whereas Houston and Dallas definitely has more opportunity, like 11,000, 12,000 in terms of cash to close shortfall. And then also kind of the affordable active listings is still constrained, but then it seems like it is a good opportunity otherwise. And we did see in some of the migration chart that Jason showed, that Freddie Mac had contributed in the report, that we are seeing outflows of Hispanic population from some of these traditional markets, such as Californias of the world, Floridas of the world, into some of these non-traditional markets, Georgia, Texas, Pennsylvania, even as well. If you go to the next slide, please. So this is my last slide. So basically, despite rising interest rates over the last few years, in many metros, there are potential first-time homebuyer households who have the enough income and credit to afford monthly payments on a moderately priced home. A small decline in interest rate will boost affordability for potential borrowers. First-time homebuyers who need down payment funds can utilize various assistance programs depending on where they are, and targeted outreach, counseling, financial literacy can overcome a lot of the knowledge barriers as well as myths around home buying process. And that's all my presentation is about. Thank you.
Thanks so much, Jaya. That was a lot of really great information from both of our panelists. So this is a time for you to put your questions into the Q&A box. I do want to just point out one thing. Jaya is not able to answer any policy questions. So please refrain from asking any policy questions. She can answer any data questions that you might have. And I am going to take the facilitator's privilege and ask the first question, but also just want to make one comment from your data, Jaya. it just seems like it is so important to work with home buyers on savings. That was such a dramatic difference in the amount of savings based on then what kind of down payment they would need. So
Absolutely.
I just wanted to point that out. That's so huge. Yes. Okay. So my first question, this will be my only question. In the LMI opportunity map, are those numbers the folks who are up to 80%, or is it the total of everybody up to 140%?
Up to 80%.
Up to 80. Oh, well, that makes a
Yes.
big difference. And so that's great. I mean, it's kind of we've been hearing so much doom and gloom about the housing market, right? But that was a little bit of a positive piece of data that you presented there. So thank you for that. So somebody did put something into the chat. Does the data include manufactured and cross mod homes?
Yeah, so there are right now, it's the single family homes. Are you talking about the supply metrics that I showed you?
Yeah.
Yeah, so that one does not include manufactured homes, co-ops, or condos, but we do have the ability to look at that separately. We have looked at that. So the shares are definitely higher, but then in terms of relative affordability, it's still, the story remains the same.
And I imagine that there's an impact on whether or not the state that the person lives in, where they're looking at manufactured housing, will allow for actually a mortgage on the manufactured home. Many states will only allow for personal loans on those, chattel it's called. So
That's
that makes a
right.
difference as well.
Yep.
So Jason, there's just one question, and it is for you. How would we get in contact with a local NAHREP office?
Yeah, so all those can be run through our national office, but on our website, we also have all of our chapters listed out, and their calendar events are on there. And so I would encourage you also to check out one of the local events that are being programmed. But if anyone has any questions, I'm happy to put my email here with everyone in the chat. I'll write that in now.
That's great.
And,
Careful what you ask for.
Exactly. No. Yeah, feel free to reach out. I can connect you internally with our chapter team.
Okay, well, that looks to be all of our questions. I don't know if any of the NHRC staff has any questions that they want to ask of either of our panelists. And it doesn't look like it. So with that, we are going to go ahead and move it to Bruce for our wrap up.
Excellent. Thank you very much. Terrific presentations and very
Can I interrupt you, Bruce? I'm
Oh,
so
of course.
sorry.
Yeah.
So another question just popped in.
All right.
Are millennial Hispanic homebuyers responsible for a large portion of the increase in their homeownership rate, or are there any insights that speak to how to reach them better?
Are they responsible or how do we reach them better? Millennial home buyers?
That's both, right? Are
Okay.
they so are millennial Hispanic buyers responsible for the increase in the homeownership rate, and are there any insights that speak to how to reach them better?
Well, yeah, I mean that, and also the next generation. I'm kind of on the tail end of the early part of millennials. I'm a lot older. That's a pretty broad range, but I think as you saw from the report, kind of that 25 to 42 is pretty large and significant. I think that from a digital factor, that's certainly very much there. But again, being able to understand the ability to originate and to help people with a multi-generational household perspective is so very important in these things, and working with lenders, I think that understand that dynamic as well is continues to be a factor. And also, the language piece is not going away. That's certainly, we continue to encourage that. LEP availability amongst lenders is increasing. I see it happening. A lot of IMBs are doing it, and some of the larger players too. So there's a lot of momentum in that space as well. But you know, I think Latinos tend to be very digitally savvy in this space, but are at the end of the day very relationship driven. So working with people that are already connected in the community is, I think, a very important factor.
I mean, I'll just add to that on the language question. There's a lot of advocates really working on language access issues and LEP issues. And so please alert us to problems you're seeing, whether it has to do with mortgage origination or mortgage servicing. CFPB has been very interested in what counselors are seeing as well. So let us know if you're seeing problems out there.